Let's have a look at this question. I hope you have all done it. Please can someone confirm that they can hear me? Can you guys hear me?
Yes, we can.
Okay, great. Okay, great. And can you guys see the question on Blackboard? Can you see the question I'm sharing? Okay, great. So let's have a look at this question. So Alpha Limited bought 50,000 Class A shares in Beta Pty Limited on the 31st of March 2019. The post-closing trial balances of Alpha Limited and Beta Pty Limited as at 31 March 2019 are as follows. So here they have given us the trial balance of Alpha and Beta and all of the items in the trial balance. Let's have a look at the required. Okay. Let's have a look at the required. Complete the analysis of owner's equity template below for Alpha Pty Limited investment in Beta as at 31 March 2019. Okay, so this is the first question we're going to have a look at. I'm going to share a template of the answer and we're going to go through it together. Someone has said that they're not receiving their data yet. Maybe you can contact the appropriate person. Unfortunately, I'm the lecturer. I'm not the person that allocates data. Okay, so I'm going to stop. Let's just go through all the requireds on the question, and then I'll stop sharing the question, and we can have a look at how to do this together. So the first required is to complete the analysis of owner's equity template below for Alpha's investment in Beta as at 31 March 2019. After we've done that, we need to have a look at step 2. Step 2 would be to prepare the pro forma journal entries. So here we need to prepare the pro forma journal entries required to eliminate Alpha's investment in Beta against the equity of Beta. So we basically want to prepare the consolidated financial statements so we know what we need to ask ourselves, what pro forma journal entries are required to do this. Then we will have a look at 2.2 where we need to prepare the pro forma journal entries required to eliminate Alpha's loan to Beta against Beta's loan liability. Okay, it sounds complicated, but when we go through it, I'm certain that you will understand what they are asking for. Then step 3 is to prepare the consolidated statement of financial position for the Alpha Group as at 31 March 2019. So those are the questions we need to have a look at. I'm going to stop sharing the question and then put a template of the solution on, and then we can go through that together. Okay, can you guys see the Excel document on your screen?
Yes, ma'am. We can.
Oh, wait. Okay, so let's have a look at the solution here. Okay, so I'm just going to zoom in a bit to make sure you guys can see. Okay, can you guys all see clearly the template there in Excel?
Yes, we can.
Okay, great. So I've zoomed in as much as I can. So here the question asked us, so the question said, complete the analysis of owner's equity template below for Alpha's investment in Beta as at 31 March 2019. So we need to have a look at the information given to us in the scenario. So if we have a look at the share capital of Beta, we can see that Beta has share capital of 50,000 and they have retained earnings in their trial balance of 20,000. So because Alpha acquired 100% of Beta, they acquired the equity, the share capital, and the retained earnings. So now we need to ask ourselves, what has Alpha paid to acquire Beta? So who can tell me by looking at the question, what was the consideration paid from Alpha to Beta for in order for Alpha to acquire Beta?
It's 80,000.
Okay, great. And where did you get that figure from, the trial balance? Okay, so that figure comes from the trial balance. If you have a look at the trial balance, you'll see in Alpha's column there that Alpha has investment in Beta of 80,000. So we know that because in Alpha's books, it is showing investment in Beta, this is the amount that Alpha paid for Beta. Okay, so that is the consideration paid in this scenario. So if the consideration paid is 80,000 and we know the value of the equity that was purchased, can anyone tell me in this situation, is there going to be goodwill or a gain from bargain purchase?
There's gonna be goodwill.
Okay, correct. It is going to be goodwill. So in this situation, we are going to have goodwill. And how much is the goodwill going to be in this scenario?
It's gonna be 10,000.
Okay, that is 100% correct. So in this situation, the goodwill is going to be 10,000. And why do we have goodwill in this situation? The reason we have goodwill is because the consideration paid was greater than what was acquired. Okay. So because they have only asked us for the at acquisition in this question, we when we look at the current period B and C in the temperature, that will be done at a later stage. So in our question here, we also don't have non-controlling interest yet because this is a wholly owned subsidiary. So next week's practical, you will have a look at how to deal with non-controlling interest, which is shown by NCI. But this week, we only looking at wholly owned subsidiaries. Okay. So if we go, so that answers the first part of the question. We had a look at what was acquired. It was basically the equity in Beta. And then we compared that to the consideration paid, which was 80,000. And this then gave us the goodwill amount of 10,000. Okay. So let me just share the solution quickly. Okay, so here you can see that I have unhighlighted the answers. Let me just zoom in a bit. So here, remember we discussed how much was paid. So we said that alpha paid 80,000 to acquire beta. So we are comparing the consideration paid of 80,000, and we're comparing that to the equity of beta, which was 70,000. So now we can see that the consideration paid of 80,000 is greater than the equity of beta. So this means that 80,000 was paid for something that is valued at 70,000. So this therefore means that there's goodwill of 10,000. Okay. I see there's lots of discussion about the assessment next week in the chat group. We'll just have to clarify what is in there, but it should be everything you have done just before the assessment. So you would have covered a bit of NCR this week, but we'll just see if that's going to be in the assessment. It should be on Blackboard already in the course outline, but we'll just confirm what's in the scope, okay? So if we have a look at the second required, so the second required said, prepare the pro forma journal entry required to eliminate Alpha Pty Limited's investment in Beta against the equity of Beta in order to prepare the consolidated financial statements of Alpha Group as at 31 March 2019. So here we are asked for the pro forma journal entries. So here we have our pro forma journal entries. Okay, so what are we going to debit and what are we going to credit in this scenario? Who can tell me what we are going to debit? So we want to know what are the pro forma journal entries to eliminate the investment in the subsidiary, which is Beta, against the equity of subsidiary at acquisition. Okay, so someone has said we're going to debit share capital. That is correct. So in the trial balance, the share capital is a credit. We are basically eliminating that share capital. So we are debiting the share capital to eliminate it. Correct. So we are also going to debit retained earnings. So in the trial balance, we would have a credit of retained earnings, but because we want to eliminate this, we are going to debit our retained earnings. Okay. Now, what else are we going to debit? So we have debited share capital and we have debited our retained earnings. But remember, we also have goodwill. In this situation, the consideration paid was greater than what was acquired. So therefore, we have goodwill. Is goodwill going to be a debit or is it going to be a credit?
A debit.
Okay, correct. So we are going to debit and raise goodwill in the pro forma journal entries. So we have looked at the three accounts we are going to debit. We are going to debit share capital of Beta, and we're going to debit retained earnings of Beta. And then because the consideration paid was 80,000, and this was greater than what was acquired, which was 70,000, we have goodwill, so we are going to debit goodwill with 10,000 Rand. Now, who can tell me what account are we going to credit? So what account are we going to credit as part of our pro forma journal entries? Okay, correct. We are going to credit the investment in Beta. And what is the amount of our credit when we process the journal entry and we go credit investment? What is the amount of the journal entry? Okay, correct. The journal entry we are going to process is a credit investment of 80,000. Okay, that is 100% correct. Okay. So now that we have had a look at the pro forma journal entry to eliminate the investment in beta, now we need to have a look at the next journal entry. Okay, so someone is asking, if we are not given the price per share, do we assume that it is R1, which makes the consideration paid 80,000? So here in this question, they gave you the trial balance and they gave you the investment in beta. So they told you the investment in beta was 80,000, and this reflects in this scenario the consideration paid. Okay. So you mustn't really just make assumptions until you're certain that the information hasn't been given to you. In this scenario, they may not have written out in a sentence that the consideration paid was 80,000, but they gave you the trial balances. And in Alpha's books, you can see that the investment in beta was 80,000. And because there were no other transactions relating to the investment in beta, we are just looking at the acquisition and there was nothing else to consider. We know that the investment in beta in Alpha's books was 80,000 Rand. So this reflects the consideration paid. Okay. So now we need to ask ourselves, is there any intra-group loans? In the trial balance, is there any transactions, any other balances that we need to eliminate in Alpha's books and Beta's books? Because remember, we are going to add the whole, our whole objective is to add the trial balance of Alpha to the trial balance of Beta. But we need to consider, is there anything else we need to eliminate? We have eliminated the investment in beta in Alpha's books, and we have raised goodwill, and we have eliminated the equity in beta. But now we need to see, are there any intra-group transactions or balances that need to be eliminated? So someone is saying we must have a look at the loan, okay, which is 100% correct. So you will see in Alpha's trial balance, they have a loan to beta shown as an asset. So in Alpha's trial balance, if you have a look at the column there, it says loan beta 100,000 Rand. And then if you have a look at Beta's trial balance is showing a loan to Alpha, a loan owing to Alpha of 100,000 Rand. So in this question, we can see that Alpha made a loan to Beta. So in Alpha's separate books, it has recorded that it made a loan to Beta. So it is shown as an asset because Beta owes Alpha money. And then in Beta's books, Beta is showing the loan as a liability because it owes Alpha this money. It received this money as a loan, and one day it will need to repay this money. So in its separate financial statements, it is okay to have the loan between Alpha and Beta. But when we are preparing the consolidated financial statements, we are basically looking at it as one company. So a company cannot owe itself money. So we need to eliminate this intra-group loan. Who can tell me what the journal entries are to eliminate this intra-group loan between Alpha and Beta? So we're basically adding the trial balances together, but because we have said that in this consolidated set of financial statements, a company cannot owe itself money. So we need to eliminate the loan that is owing from Beta to Alpha. So what are the journal entries we are going to do to eliminate this intra-group loan? So someone has said we are debiting investment and credit loan. It's half correct. It's not 100% correct. So we basically need to go debit. We need to debit the loan to eliminate the loan in Beta's books. So in Beta's books, Beta is showing a credit loan balance because it owes money to Alpha. So because it is a credit in Beta's books, we need to debit this to eliminate it. So we're going to go debit loan in Beta's books of 100,000 Rand to eliminate that line item. And then we're going to credit the loan that is reflected in Alpha's books. So we're going to go credit loan that is shown in Alpha's books of 100,000 Rand. So in Alpha's separate trial balance, this loan owing to Alpha is shown as a debit because it is an asset for Alpha. So therefore we need to credit this in order to eliminate it. Okay, let me see if I can unhighlight the solutions and then we can have a look. Okay, so here you can see we have gone debit loan Alpha and we have credited loan Beta of 100,000 Rand. And this will therefore eliminate that intergroup loan. Okay. And then here in step 2.1, we discussed the elimination of the investment in Beta and the equity of Beta, and this resulted in goodwill being recorded. Do you guys have any questions on these journal entries here? Any questions on these journal entries?
Good afternoon, ma'am.
Hello, yes.
My question is on analysis of owner's equity. I want to know the amount shown in Rand.
Sorry, can you just say that again? You're breaking up.
All the amounts in the analysis of owner's equity, are they shown in Rand?
Yes, so these amounts are all shown in rands and there doesn't appear to be any rounding. So the 50,000 is showing 50,000 Rand. Okay, so it's all rands in step 1 here. So this is all in rands. And then also in the journal entries we have just been looking at, this is all showing rands. Okay.
Okay, thanks, ma'am. And my second question is, in the trial balance, the share capital and the retained earnings is shown in bracket. What does that mean?
Okay, so in the trial balance here, okay, that is a very good question. So if you have a look at the trial balance, you'll see that some numbers are shown in brackets and some are not shown in brackets. So those numbers that are shown in brackets reflect a credit balance. So think of your debits and your credits, and then have a look at the trial balance here. You'll see the share capital is shown in brackets. This means that that share capital is a credit balance. So if you have a look at your trial balance, you'll see retained earnings is also in brackets. So this reflects a credit balance. And then you'll see that your trade and other receivables is not shown in brackets. So it's not shown in brackets because it is a debit balance. Okay. And then you'll see also inventories is not shown in brackets, and the reason it is not shown in brackets is because it is a debit. It is a debit. Okay, inventories is a debit, and then you'll see that trade and other payables is shown in brackets, and the reason trade and other payables is shown in brackets is because it is a credit. Okay, does that make sense?
Yes, ma'am. Thanks.
Okay. Okay, so then we have another question. Why are we supposed to eliminate? Okay, so the reason we eliminate is that our aim here is to prepare the consolidated financial statements. Okay, so we have separate financial statements and then we have consolidated financial statements. In the separate financial statements, it is okay for alpha to show the investment in beta. So in the separate financial statements, alpha can show the investment in beta and it's not a problem. And in beta's separate financial statements, for just itself, it will show its share capital and its retained earnings. But when we combine these two companies, we need to make certain pro forma journal entries to eliminate these items. And also, we need to make pro forma journal entries to eliminate any balances between these companies. So for example, in Alpha's books, it is okay for Alpha to show the loan to Beta as an asset. And in Beta's books, it is okay for Beta to show the loan owing to Alpha. But when we take Alpha and we add Beta and we prepare what is called the consolidated financial statements, we are basically looking at Alpha and Beta as one company in the consolidated financial statements. So when we look at it from a group perspective, alpha and beta together, we're seeing it kind of as one big company. So we cannot owe ourselves money. So when we do the consolidated financial statements, we need to eliminate the loan that is owing to alpha from beta. In its separate financial statements, alpha will show this loan and beta will show this loan, and that is correct. But when we prepare the consolidated financial statements, we cannot have a loan owing from beta to alpha because we are looking at it from one perspective, almost as if it's like one company. Okay. So let's just go through the pro forma journal entries. So when Alpha acquired Beta, on its consolidation, there are certain pro forma journal entries we need to show. Okay. So when we are preparing the consolidated financial statements, we will set the amount paid for Beta against the equity in Beta. And then we will see if there's goodwill or if there's a gain on bargain purchase. So in this situation, there was goodwill, and the reason there was goodwill was because the investment in Beta was 80,000. So here we are basically eliminating the investment in Beta in Alpha's books to the equity of Beta in Beta's books. Okay, it sounds complicated, but let's go through it again systematically. So in Beta's trial balance, it would have its share capital, and this would be shown at a credit of 50,000 Rand. But when we combine Beta's books and Alpha's books and prepare the consolidated financial statements, we need to eliminate the share capital. So we are going to go debit share capital of Beta, and that was 50,000. Then we had retained earnings. Beta had retained earnings of 20,000 Rand in its records, in its separate financial statements. But in its consolidated financial statements, this needs to be eliminated against the investment in Beta. So because it was a credit in the separate financial statements, we now need to debit it, okay, to eliminate it. We basically want to do away with it. So we're going to go debit retained earnings of Beta of 20,000 Rand. So we have essentially eliminated the equity of beta. And this is only in the consolidated financial statements will these pro forma journal entries be processed. This will not affect the individual financial statements. So separate financial statements will still be prepared for beta separately and alpha separately. But when we're looking at the consolidated financial statements, these are the pro forma journal entries that will be passed. So we have eliminated the equity in beta, and we have also eliminated the investment in beta. So in alpha's financial statements, in its separate financial statements, it will show debit investment in beta of 80,000 Rand. And this shows the consideration paid that alpha paid for beta. So because it is a debit in alpha's separate financial statements, when we prepare consolidated financial statements, we need to eliminate this investment against the equity in beta. So because it is a debit investment in beta, in alpha's trial balance or financial statements, to eliminate that investment in beta, we need to credit it. So the pro forma journal entries will show a credit investment in beta of 80,000. So this shows the consideration paid. So now if we compare the consideration paid of 80,000, alpha paid 80,000 Rand to acquire beta, and we compare that 80,000 Rand to the value of what was acquired, we can see that the value of the equity of beta is 70,000. So we paid 80,000 Rand for something that is recorded as 70,000. So therefore we overpaid, or we can be seen as overpaying, but in actual fact there was goodwill of 10,000 Rand. So if we take the consideration paid of 80,000 and we subtract the equity or what was acquired, which is 70,000 Rand, we can see we have goodwill, which is a debit balance of 10,000 Rand. What would the situation be if we had paid 60,000 Rand and the equity in beta was 70,000? So if alpha had paid 60,000 Rand and the equity was 70,000 Rand, what would we do in that situation? Okay, Abdul has gotten it correct. We would have a gain on bargain purchase in that situation, and that would be recorded as a credit gain on bargain purchase. Okay, well done. So remember, those are the elimination pro forma journal entries. Then that was the first step, to eliminate the equity in beta against the investment in beta, and then raise goodwill or see if there's a gain on bargain purchase. The next step is to have a look at the separate financial statements or separate trial balances and see, is there any intragroup balance or intergroup loan? In this situation, alpha made a loan to beta. So alpha's separate financial statements showed a loan to beta as an asset, because beta will have to pay this money back to alpha. And in beta's separate financial statements, it's showing a loan as a liability, because it will have to pay this money to alpha eventually. So that is fine. In the separate financial statements, there's nothing wrong. In alpha's financial statements, there's nothing wrong with having a loan owing to it from beta. And in beta's separate financial statements, it can show this loan owing to alpha. There's nothing wrong with that. But on consolidation, we are basically adding alpha and beta together and seeing it as one company. So a company cannot owe itself money. So this intergroup loan needs to be eliminated. And this is the journal entries we have just gone through. So we're going to debit the loan of 100,000 Rand to eliminate it in Beta's books. And then we're going to credit the loan to eliminate this amount in Alpha's books. Okay, are you guys all happy with the pro forma journal entries? Let me just have a look at the chat and see what's going on. Okay. Okay, you guys seem fun. Okay, so I've gone through the journal entries again as requested. Now, the third required, now that we have done the pro forma journal entries, the third required is to prepare the consolidated statement of financial position for the Alpha Group as at 31 March 2019. So this is the consolidated group. So this is going to show Alpha and Beta's figures. And this is different to the separate financial statements. So separate financial statements will still be prepared for Alpha, and separate financial statements will still be prepared for Beta. But there also needs to be prepared consolidated financial statements. So we are going to look at how to prepare the consolidated statement of financial position for the group. So let's just go in the Excel document here. Now, how are we going to prepare the consolidated financial statements? So like I said, we need to add everything in Alpha to everything in Beta. So let's go line by line through the trial balance and see what the consolidated statement of financial position will show. So in Alpha's trial balance, you'll see that Alpha has PPE of 50,000 Rand. And Beta has PPE of 60,000 Rand. So this is going to be added together to equal 110,000 Rand in the consolidated financial statements. So in Alpha's separate financial statements, Alpha will show PPE of 50,000 Rand in the separate financial statements of Alpha. And Beta will show 60,000 Rand of property, plant, and equipment in Beta's separate financial statements. But when we prepare the consolidated financial statements, we are adding the PPE of Alpha and adding the PPE of Beta and looking at it as if it is one company. So consolidated, the property, plant, and equipment of the group is 110,000 Rand. Okay. Then let's have a look at the investment in Beta. So in Alpha's separate financial statement, it has recorded an investment in Beta of 80,000 Rand. And we would add this to any investment in Beta, okay? Obviously, there's no investment in Beta, but we're adding Alpha plus Beta. But remember, we eliminated this investment in Beta by passing the pro forma journal entry. So in Alpha's books, yes, it would show the investment in Beta. But remember, in the consolidated statement of financial position, this investment in Beta would not be shown. So have a look at the pro forma journal entry column. So this basically shows the journal entries that we looked at just now. So remember that pro forma journal entry here, where we debited share capital and retained earnings, and we credited our investment in Beta. This is shown in the pro forma journal entry column over there. So this credit was processed when the consolidated financial statements were prepared, and this therefore means we're going Alpha plus Beta, and then we're adding this column as well. So in the consolidated financial statements, there will be 0. Investment in Beta will not be shown because of the pro forma elimination journal entries. Okay, is that clear? So in Alpha's books, the investment in beta will still be shown in Alpha's separate financial statements. But in the consolidated financial statements, because of the eliminating pro forma journal entries, there is going to be no investment in beta. Okay, and it's the same with the loan here. In Alpha's separate financial statements, it recorded the loan as an asset because this loan was made to Beta. So Beta owes Alpha 100,000 Rand. So in Alpha's separate financial statements, it can show this loan to be received from Beta as 100,000 Rand. However, when we look at the consolidated financial statements, we must remember that we eliminated this when we did the pro forma journal entries. So this is going to be 100,000, and then we eliminated this with our journal entries. So in the consolidated financial statements of the group, there's not going to be a loan showing owing from beta to alpha. But in alpha's separate financial statements, it will still show this amount of 100,000 Rand. But because we processed that pro forma journal entry of 100,000 Rand here, this eliminated that when we were preparing the consolidation. Okay. Let's go through the next one. So we have looked at the loan. Now we need to look at goodwill. So you will see in Alpha's separate financial statements, there is no goodwill. And in Beta's separate financial statements, there is no goodwill. But when the pro forma journal entries were done on acquisition, goodwill was recognized and raised. And this needs to be shown in the consolidated financial statements. So remember, we calculated the goodwill as 10,000 Rand, and this came about from the pro forma journal entries. So even though we are adding alpha and we are adding beta, there was no goodwill in alpha or beta in its separate financial statements as a result of the acquisition. But then we processed the journal entry for goodwill because the consideration paid was 80,000 Rand and they were purchasing something that was worth 70,000 Rand. So therefore goodwill of 10,000 Rand was raised. So if we just go to our journal entries, see goodwill is here. We debited goodwill in our pro forma journal entries, and that is what we are showing here. So we have debited goodwill, 10,000 Rand, and then this filters through to the financial statements. So goodwill debited 10,000 Rand, and that means we are raising this goodwill in the consolidated financial statements. Then let's have a look at the trade and other receivables. So Alpha had trade and other receivables of 40,000 Rand in its separate financial statements. Beta had 15,000 Rand in its separate financial statements. On consolidation, we are going to go alpha plus beta, and then if there's any pro forma journal entries, we will also take that into account. So here we are going 40,000 plus 15,000, and that gives us trade and other receivables of 55,000 Rand in the consolidated financial statements. Then if we have a look at inventories, so inventory will be shown in Alpha's statement of financial position as 20,000. That is in its separate financial statements. In Beta's separate financial statement, Beta will have inventory of 35,000 Rand. So in the consolidated financial statements, we're going to go alpha plus beta. So 20,000 Rand plus 35,000 Rand, and that will give us 55,000 Rand in the consolidated financial statements. Then we have bank. So alpha has an amount of bank of 25,000 Rand, and beta has 78,000 Rand as a bank in its separate financial statements. In the consolidated financial statements, we need to add these amounts. So we're going to go alpha plus beta to get the amount of bank in the consolidated financial statements. So 25,000 Rand of alpha's bank plus 78,000 Rand representing the bank in beta's financial statements. Together, this will give us a consolidated bank of 103,000. So this represents the assets in the consolidated financial statements. So you can see alpha's column shows its separate financial statements. Beta shows its separate financial statements. They have the pro forma journal entries, which we recorded previously, and these together, all those columns together, will give us the consolidated financial statements. So now that we have had a look at assets, let's go down to the equity and the liabilities. So if we have a look at the equity and liabilities, alpha, you can see it has 100,000 Rand share capital in its separate financial statements. And beta has 50,000 Rand in share capital in its separate financial statements. And then remember, when we were processing our pro forma journal entries, we needed to eliminate the share capital in beta's books. So I've highlighted that in orange. So we're going debit share capital to eliminate the share capital in beta's books. So this represents the pro forma journal entry column over here. So even though in beta's books, it has a credit of share capital of 50,000 Rand, we eliminate this in our pro forma journal entries. So therefore, when we have a look at our consolidated financial statements, we're going alpha plus beta plus the pro forma journal entries. So we're going 100,000 Rand plus 50,000 Rand minus 50,000 Rand, which represents the eliminating journal entry, and this will give us 100,000 Rand share capital in the consolidated financial statements. And it's the same with retained earnings. Okay, so in retained earnings, we had 80,000 Rand in alpha's separate financial statements, and in beta's separate financial statements, beta has retained earnings of 20,000 Rand. But then remember, we processed the pro forma journal entries previously, and we eliminated the retained earnings in beta of 20,000 Rand. So that retained earnings here, this debit retained earnings, eliminates the retained earnings in beta on consolidation. So here we are going retained earnings of alpha plus retained earnings of beta plus the pro forma journal entry. So it is 80 plus 20 and then minus 20, which gives us 80,000 Rand of retained earnings in the consolidated financial statements. Then let's have a look at the interest-bearing loan. So in Alpha's separate financial statements, it shows an interest-bearing loan of 120,000 Rand. And Beta does not show an interest-bearing loan. So when we combine this, you will see in the consolidated financial statements, we have an interest-bearing loan of 120,000 Rand. So who can tell me this interest-bearing loan why did we not include it and eliminate it in our pro forma journal entries? So this is an interest-bearing loan. Why did we not eliminate it in our pro forma journal entries? Okay. Okay, Maleka, well done. It does not relate to beta. That is 100% correct. It is not an intragroup loan. So this interest-bearing loan must be with a third party like a bank because it is interest-bearing, okay? And also, beta is not showing anything to do with this interest-bearing loan in its books. So this interest-bearing loan is not a loan that was between alpha and beta. It was obviously with a third party like a bank. So this interest-bearing loan does not have to be eliminated because it is not an intragroup loan. An intragroup loan is a loan between alpha and beta. This interest-bearing loan does not say interest-bearing loan beta or alpha, so it is also interest-bearing, which means it's with an unrelated party, likely like a bank. So we're going to go alpha of 120,000 Rand. So this interest-bearing loan will be shown in its separate financial statements of alpha, and then we are going to add it into the consolidated financial statements. So there is no pro forma journal entry for the interest-bearing loan because it is with a bank. It is not with alpha or beta. It is not between alpha or beta. It is not an intragroup loan. So therefore, there is no elimination required. So if we compare this interest-bearing loan to the loan that alpha gave to beta, we can see how it is treated differently. So in beta's books, this loan that was owing to alpha was shown as a liability. Then remember, we said it was an intragroup loan, meaning that it needs to be eliminated. So in beta's books, the loan is shown as a credit. So we are then going to debit in our pro forma journal entries, which is what we did here. We debited loan owing to alpha of 100,000 Rand. And this then means that on consolidation, the amount is eliminated in the consolidated financial statements. So we'll say alpha plus beta, and then we also plus the pro forma journal entry column. So 100,000 Rand minus 100,000 Rand. This represents the journal entry processed. This will give us 0. So in the consolidated financial statements, the loan between beta and alpha will not be shown. But in its separate financial statements, in beta's separate financial statements, it will show this loan owing to alpha of 100,000 Rand. But in the consolidated financial statements, this loan balance will be 0 because it is an intragroup loan. It is eliminated on consolidation. Okay. Then, does anyone have a question on this?
No, ma'am. I want to ask at the end of the tutorial. You can finish.
Okay. Okay, that's fine. We're almost at the end. Then we have trade and other payables. So trade and other payables in Alpha's book is 15,000 Rand. So in Alpha's separate financial statements, it will show trade and other payables of 15,000 Rand. And Beta, in its separate financial statements, will show trade and other payables of 18,000 Rand. On consolidation, we're going to go alpha plus beta, and this is going to give us 33,000 Rand of trade and other payables. So we're going 15,000 trade and other payables in alpha plus 18,000 Rand trade and other payables in beta. And this gives us 33,000 Rand trade and other payables in the consolidated financial statements. So these are our workings here that we have gone through. This final column represents the consolidated statement of financial position. So this was just our workings. This is not actually the final set of financial statements. So you'll see in a set of financial statements, they won't show this. These are just our workings. So now I have highlighted the column in orange. This is the consolidated column, and this will then be shown in the statement of financial position, in the consolidated statement of financial position. Okay. So here you'll see property, plant and equipment was 110,000 Rand. And we said that was made up of alpha and beta, 50,000 Rand alpha PPE, 60,000 Rand beta PPE, okay, and so on. So we've gone through all of this. So you'll see this column here in the statement of financial position. This agrees to the column in the workings that I went through with you. So you'll see here in the statement of financial position under non-current assets, we have the consolidated PPE figure of 110,000 Rand. And remember, we raised goodwill of 10,000 Rand. And you'll notice that the investment in beta is not shown here. And the reason is because this is the consolidated financial statements. And then under your current assets, we calculated the consolidated trade and other receivables of 50,000 Rand, and we had inventory consolidated of 55,000 Rand, and we had bank of 103,000 Rand. So this column is the consolidated financial statements. Then if we go to equity and liabilities, you'll see equity here. This is exactly what we did in the workings below. This share capital of 100,000 Rand, this is only Alpha's share capital. Remember, we eliminated Beta's share capital in our pro forma journal entries. So even though Beta will have share capital in its separate financial statements of 50,000 Rand, in the consolidated financial statements here, we only show Alpha's because Beta's was eliminated on acquisition. And it's the same story with retained earnings. This retained earnings here of 80,000 Rand is Alpha's. Remember when we did our workings here, we added the retained earnings of both, but then the pro forma journal entry eliminated the equity in Beta. So therefore, in our consolidated statement of financial position, we are just showing the retained earnings of Alpha essentially. Then we have our interest-bearing loan here of 120,000 Rand. And we said that this was an external loan. It was not intragroup, so therefore it was not eliminated. Then we had current liabilities. We had trade and other payables of 33,000 Rand consolidated, and this was made up of 15,000 Rand of Alpha and 18,000 Rand of Beta. So remember, we did this working here. We added 15,000 plus 18,000, and that gave us 33,000. Okay, so this is the last required. They ask you for the statement of financial position. And that is what we have done. So we went through the workings in details. Okay, do you guys have any questions on this scenario?
Yes, ma'am.
Yes, what's your question?
Well, my question is, let's say, for example, there was an intergroup transaction on inventory or trade receivables or whatever the case is. How would we treat that in their respective journal entries and consolidated financial statements?
Well, it would likely be treated in the same way as the loans are treated. You generally don't see intercompany transactions like that at this stage. But you would just logically think to yourself when you're doing the consolidated financial statements, you're seeing the company as one. So what journal entries would need to be processed to eliminate, you know, the intragroup transactions or loans? So it really depends on the scenario, but just think about the consolidated financial statements and how they're different to the separate financial statements. So, yeah.
So okay, just for example, just giving an example of inventory, right?
Okay.
Say the parent company sold 10,000 rand worth of inventory to the subsidiary company, right? So
Okay.
as our pro forma, yeah, we'll have inventory and we'll have those journals. What would we have under that third column of what was it? The P something I forgot. Pro forma.
Pro forma journal entry. So if we have a situation where alpha is selling to beta inventory, and then we're looking at it from a one company perspective. So it's fine for alpha to have its separate financial statements showing that transaction. But the problem is when we are preparing the consolidated financial statements, it's seen as one company and you can't sell to yourself. So that would also have to be eliminated. So on consolidation. So if you raise revenue, if alpha sold to beta, then you would need to reverse that. So if you credited revenue in alpha's books, then you would need to reverse that to show on consolidation that revenue is basically fake because you cannot sell to yourself.
Yeah.
Does that answer your question?
So I would say debit revenue, credit inventory.
Well,
Of
you're in that
10,000.
situation because you're seeing it as one company, so you cannot sell to yourself.
So then would I have to minus 10,000 from the 20? Uh, so what would my third column entail?
So there you would so if well, I think what's important is that before you can do your pro forma journal entries, you need to understand what journal entry was raised or recorded when alpha sold to beta. So if alpha sold to beta, you would be crediting revenue, and then maybe they bought on credit. So then you would either debit, so in Alpha's books, the journal entry would be if they sold for cash, it would be debit bank and then credit revenue to record the sale. But then in your consolidated financial statements, the bank of alpha and beta is seen as one. So then you would just reverse it. You would go credit bank and then debit revenue. So before you can understand what your pro forma journal entry is, you need to understand what was the original journal entry in alpha and beta's books. Does that make sense? Okay, let's just see what other questions there are. So someone is asking in the test, which one do you want to see? So you would have to look at the mark allocation. It's best to show your workings as much as possible so that if you got the final column incorrect, so say for bank, if you went 25,000, or let's rather look at share capital. So if you're going 100,000 Rand plus 50,000 Rand, and then you have your pro forma journal entry of 50,000 Rand, that will give you 100,000 Rand. So if you got the pro forma journal entry wrong, and you went 100,000 plus 50, maybe minus 40, then your answer would be incorrect. But if we can see your workings, then you might get a method mark, okay? So it's best to show your workings as much as possible in a test or exam. So I would recommend doing these workings, but remember now, you can't just do these workings and then not actually prepare the statement of financial position. So you need to do these workings, and then you need to still prepare the statement of financial position. And it would be nice if you could reference your workings so we can see where your numbers are coming from, okay? Then someone is asking, how do you pick up that this is an intergroup transaction? So let me stop sharing this screen. If you have a look at the scenario, I'll share the question again. So if you have a look at the trial balance here, they're saying loan beta Pty limited, and it's showing an alpha's column or alpha's trial balance of 100,000 Rand. So you can see that it's in alpha's column, but it involves beta. So this is clearly a loan from alpha to beta. And this, therefore, on consolidation is an intragroup loan, and it needs to be eliminated. And so you can see the 100,000 Rand in alpha's column, but you can also see a credit of 100,000 Rand in beta's column. So you know that they are basically showing both sides of the transaction. Alpha made a loan to beta, so alpha is showing the money that beta owes it, and beta is showing the money that it owes alpha. So it's basically showing both sides of the transaction. So you can see in beta's books, it has a loan to alpha, a loan owing. So it got this loan, now it needs to pay it back of 100,000 Rand. So you can see by looking at the names here that it is a loan between alpha and beta. And then on consolidation, it is considered intragroup, and it needs to be eliminated. Whereas if we look at the interest-bearing borrowings, it doesn't say who it's with. It should probably say like ABC Bank or whoever the person is, but it definitely is not between alpha and beta, because this 120,000 would need to be shown in beta's book somewhere if it is an intragroup transaction. Okay, does that answer your question? Yeah, so it needs to specify that it's from one company to another. So in this test, are we going to be tested on acquisition date being the same as the consolidation date in this coming test? So based on what you've done, it would appear that yes, that is the case. Okay, so I think I've answered all the questions, guys. We will confirm the scope of test 2 next week on Blackboard. But yeah, it's basically everything you've done, everything you've covered up until the assessment. So good luck with your studying, guys. Yes, do you have a question?
I just want to ask, so your assets and your total equity and liabilities have to be the same to show that your work is correct.
That is correct. Well, okay, your liabilities, do you mean your assets has to equal your liabilities
Yes.
plus your equity?
Yes.
Okay, so yeah, these two should be equal. It shows it's balanced. It doesn't mean it's correct because you can
Okay.
balance, it could be 200,000, but it could still be balanced and incorrect.
Oh, okay.
Does that make
Thank you.
sense? So I wouldn't worry too much about balancing. It does indicate there's a mistake somewhere, but it could just be one number. So, and we're not going to look at those two and say, do they balance? Because realistically, in an assessment, students are under pressure, so they generally won't balance. But we generally don't give marks if they balance. We look at the transactions and the other figures, okay?
Okay, thank you.
Okay. So that is it from me, guys. If you have any questions, you're welcome to email the tutors or email myself, and we'll get back to you. But all the best for your studying for the assessment. I'm sure you'll all do well.